Hello, everybody. Welcome back to the rationalinvestor.coms. This is our fun little broadcast we do through FOMC meetings. Getting ready for Jerry and the Jets, or something like that. If you haven't already seen, big news: Federal Reserve kept Fed funds rate unchanged at 4.25% to 4.5%. And you can see this is the place where we are now with our short-term interest rates. It's not a huge change, but if anything, I have made the comment that I was a little surprised to see them actually start to cut rates here ahead of the US election, which I think actually they were trying to manipulate the results of the US election, and that went horribly wrong for them. And now, because they were kind of premature in cutting rates there last fall, I think actually they're going to have to go on pause here for a while. Be interesting to see if we play out the same way we did through the sickness cycle. And do we all of a sudden mysteriously have a case where they have to, in a great panic, take rates to absolutely nothing? Maybe. It wouldn't surprise me. I do see a number of countries around the world are in pretty big trouble economically, including my country. But really, everything that we teach at TRI, that's to be perfectly expected. Actually, spent some time. There's an interesting image for you. Larry put out a recent video. We like to watch that at TRI. It's a public video, so I don't think it's too big of a deal having his face on the screen here. But actually interesting, Larry here is thinking about the market getting ready to rally. Frankly speaking, I kind of have to agree with him. I had on the screen when I first fired up the video the breadth of the market. This is TRI's proprietary breadth indicator, and you can clearly see this market is washed out. The international equity markets, whether it be this is a European proxy, this is Canada, and I like to include Canada because it's got a whole bunch of commodity assets in it, so it's a good proxy on commodity demand. And of course, here's your S&P 500. And I got to tell you, everything's looking pretty darn washed out. Here's, of course, the Dow Industrials, the transports, the utilities. Sector ETFs, commodities in general. I mean, just everything's on its knees. So it doesn't surprise me that people like professionals like Mr. Williams here are thinking that the market's going to rally, or at the very least lift off of its lows. Do we see new highs here in the near term? I don't know. That's a tough one. I've been making the argument all along here that the January barometer is a pretty good read on what to expect for the year. And I think that we're basically right about here right now. And, kind of like Larry's thinking, I think there's actually going to be one heck of a big rally here in our not too distant future. And actually interesting that, the whole idea, drill, baby, drill. I'm hearing a lot of talk that oil prices coming off should help this inflation problem, which should abate a lot of fears in the marketplace. I think you might also argue, too, that to a certain degree, the Fed keeping rates up here is actually probably going to really put the kibosh on inflation, even though they are really talking about uncertainty with regard to tariffs and all that kind of talk. I could see the higher interest rates are really going to bite into things like crude oil prices and commodity demand around the world. All right, so I have been informed that Jerry is at the podium, so let's put on our short-term chart deck, and then maybe we'll circle back around and do a summary at the end of all this. So where is our short-term charts?
Overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing
Brian's looking like a little bit of a goof. Where is
Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%.
Anyway, Jerry is speaking. I think what we'll do is
seen over the second half of
let's throw
2024.
on
Surveys of
the video.
households
Can
and
you send me the
businesses
video
point to
link?
heightened uncertainty about the economic outlook. It remains to be
Chris?
seen how these developments might
And, all
affect
right, so we
future
should
spending
have
and
Jerry
investment.
sitting right over the corner here.
In our summary of
let's watch
economic
how the
projections,
markets,
the median
react to
participant
them.
projects
Thank you,
GDP
sir.
to rise 1.7% this year, somewhat lower than projected in December,
I'll put myself on
and to
mute.
rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby. Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the five-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros of the Wall Street Journal.
And U.S. dollars taking it on the chin here.
Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can.
I wonder if they undermined him with that microphone issue.
And you're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the They wrote down, meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity.
Keep in mind, these guys are usually
The cost of doing
wrong.
that, given that the economy is still solid.
Inflation
very low.
is transitory.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature that has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect, by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation.
You were well
As there are
aware that
differences
you were
and similarities.
wrong?
I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday,
Stocks
the
catching a
UCLA
wicked
Emerson
bid
forecast
along with
said
crypto.
There high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months a 1 in 4 chance of a recession.
There
so
goes
the question
Bitcoin.
is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer, and have nothing new for you on that today.
Well, maybe I'll have another mulligan.
Dodge.
As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will.
Looks like
use our
Mr.
tools to
Fink is
foster
taking
achievement of our
Bitcoin
goals
up to make
the
sure
best
his
we
put
can.
options expire
And
worthless.
of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like?
I hear a lot of Chair
If there were
Powells.
specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly. Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Did they airbrush her
So a
face?
couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in
Bit of a
through
pivot
reserve
here.
banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire. Claire Jones, Financial Times. You said in January, Chair Powell, that
I like this lady.
inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what's big.
Corn moving to new highs.
We kind of know they're going to be tariffs, and they tend to bring growth down. They tend to bring inflation up.
Stocks on fire.
So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell.
Take that, Trump.
The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last.
That was really important what he just said there.
About some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macroeconomy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the twos, with probably a little
That comes
bit of a
20
pickup
years from now.
associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed,
Agreed.
which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair.
Not Doge, Dodge.
You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those. And so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why pretty strong support. I just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
So there you go. Where do we begin? What do you think, Chris? Should we have a chat here, or should we just wind it up?
I don't see anything wrong with a little chat here.
All right. Let's see. Oh, we had a good 60, 70 people there in the video watching. I hope you all enjoyed the chat. Any key takeaways from all of this? You know what? I think the biggest problem that I have right now is I don't think that any of the price action that you're seeing on the screen right now has anything to do whatsoever with Mr. Powell and Fed policy going forward. That's a pretty ugly statement, eh? I actually think, believe it or not, that most of what you're seeing in the marketplace has everything to do with Friday. Now, why on earth would I say something like that? Friday, if you're not aware, is options expiry. I suppose we need to find what screen Brian happens to have his options expiry information on. Let's see over here. And looking at the S&P 500 here, you can see on my screen, hopefully I have this on the screen. I'm not sure if I do or not. 568.88 up $7.92, just rocking and rolling here, up 1.5%. I mean, are you trying to tell me that the Fed deciding to not adjust interest rates and interest rates are relatively elevated, like historically speaking? It used to always be, you want a guarantee, I'll show you 3%. And typically short-term interest rates would sit at 3%. That was your risk-free rate. So here we are at 4.5%, 50% higher than that historically normal risk-free rate. The fact that they did not cut interest rates, on balance, I would have actually assumed that would actually be very US dollar bullish, relatively speaking, getting paid a lot of money to hold US dollars. And it would also sort of speak to, well, is inflation a problem here? And when do we get back to growth? So I think the biggest thing that's driving this, of course, this is the monthly options expiry, and this is a quarterly one, really big. We used to call these the quadruple witching events, March, June, September, and December. So a lot of institutional people play the March options. And if we scroll down here, most of the puts that you see in the marketplace are actually written. Keep in mind, every option has a buyer and a seller. So the writers are the sellers of the options. Most of these puts are actually written by institutional people. And, the Goldman Sachs, Merrill Lynch's, all that kind of idea. And ideally, in their world, they'd like to write a put option and then just, collect a premium for that put, and then just have the put expire worthless, kind of like how your insurance company writes you an insurance policy on your car every month. You make the payment, and of course, ideally, they don't want to have to pay out you crashing your car or somebody else crashing into you. They would prefer that the policy is just not exercised. So same logic in the options market. It's exactly the same logic. So you can see all of these put options in some pretty darn big numbers. Like in our daily video today, one option series contract that jumps out at me that I think the market really needs to get above is this $580 strike. There's 125,000 contracts. And when you actually calculate the notional value of this derivative exposure here, it's like in the billions of dollars, like billions, like serious amounts of money. And then you'll notice, look at it. I mean, you got 20, 26, 40, 73, 11, 49, 7. I mean, these are pretty damn big numbers. But notice once we get above this level, look how the numbers start to thin out appreciably. And this is very, very consistent in the market. So it's just, month in, month out, it's always the same. So I do believe that there is a lot of incentive to get this S&P 500 up above that 580 level into Friday, which is only a couple days away. And I think to a certain degree, it does explain why we're seeing such an egregious rally here. What I would actually consider, I wasn't overly impressed with that press conference. What I'm hearing is a lot of sort of business as usual. pass the buck kind of talk. And of course, there is this standoff happening right now between the executive branch, and you even heard Jerry make reference to this, that you can almost hear it in his speech, talking about how this administration is going to have a very different policy than previous administrations. And I do believe there's a bit of a jousting match. In fact, the most important statement that I heard from Jerry through that whole episode there was his biggest concern. You heard somebody ask, I can't remember how the question went specifically, but his biggest concern right now is not so much change in policy. It's more of a forced change of mandate in the Federal Reserve Board going forward. And that really caught my attention. And when I heard that, I was like, whoa, that's a pretty important statement. I do believe that while Mr. Powell is on the job, and you've heard him in previous press conferences say, well, this is the law and there's no way you're going to get me to move, and I've got a mandate here while I serve out my term. And I do believe that Mr. Trump is not going to try and upset that apple cart. But I do think that Mr. Powell is going to serve out his term, and his term comes to an end, I think, in 2026, if I'm not mistaken. And then I believe there could be some serious changes in how the U.S. Federal Reserve Board is required to act. And the whole idea that this framework that they're working under right now, I think Mr. Trump would like to change that dramatically. So that was the biggest thing that jumped out at me, believe it or not, out of this whole press conference. Looking at the price action in the marketplace, we had on the short-term charts, what's the knee-jerk reaction. I always like to watch the short-term charts. Like I said, it's sort of, if somebody says something dramatic, you can really see it in the price charts very quickly. Saw primarily through the entire press conference, the US dollar selling off. But the interesting thing is that this was this 4-hour candle. Wasn't really like it was breaking to new lows or breaking to new highs. We were just kind of trapped in a trading range, and we were up near the upper end of the trading range. And then basically through the majority of the conference, the press conference, the US dollar index came off. And I literally watched through the entire conference, all of the currencies all lift against the US dollar. Which doesn't make any sense. I mean, frankly speaking, economics to me, this feels like the market will remain illogical far longer than anyone can remain solvent. And, you heard Jerry speak about the significant uncertainties going forward. And frankly speaking, I think that is probably the biggest concern that we have right now is I don't think anybody really knows how all this tariff stuff is going to play out. Mr. Trump has one idea in mind of how he thinks that this is all going to play out, but I have a sneaky suspicion that he's actually going to get the exact opposite effect. Unfortunately, TRIers, you hear a great sort of ranting from Brian about the inflation expectations that we should expect in, say, 2027, 2028, based on the last great reset, the 1940s, and how prices had to be dramatically revised higher into the latter part of the decade. And my hunch here is, historically, tariffs don't really translate into more economic activity. They actually translate into lesser economic activity. You did hear Jerry say to a certain degree that his expectation is that U.S. And actually, I think this was more a comment from Larry than from Jerry. keep the name straight here, that higher tariffs will encourage job growth within the United States. And as long as we drill, baby, drill, and make sure that that energy price is coming down, on balance, the whole thing should sort of sort itself out, and it should be a zero-sum game, i.e. falling energy prices will be deflationary, but the rising prices within the U.S. market will be inflationary. But the whole thing comes to a zero-sum game. I don't know. We'll see how that goes. That obviously is the huge uncertainty here right now. So knee-jerk reaction, and the one thing that jumped out at me watching all of this, and I always tell you guys through these conferences, is watch the bonds. Which way are the bonds acting? The bonds here, this entire press conference was all about their expectation of weaker economy and lower inflationary pressures going forward. So that's kind of a head scratcher. And if anything, something that kind of jumps out at me that's a bit bothersome is, are we going to go back to an inverted yield curve? For quite some time, you heard Jerry talking about wanting to clean up the balance sheet, normalize the capital markets, all that kind of talk. But I get the distinct impression that the entire yield curve, as it stands right now, you could argue that basically the yield curve is normal and actually healthy and just business as usual. Companies borrow at the short end, they lend at the long end, and this is basically their profit margin in the financial services industry. But now we're, with what you've seen in the marketplace today, and, actually these are, here. I mean, these are rising bond prices. And of course, this is the short end. This is the 5-year. This is the 10-year. This is the 30-year. So prices are rising right across the board, which means that yields are falling right across the board. But even on the 2-year note, yields are falling. Prices are rising. But the Fed's not moving. So what that says to me is that, these yields here are going to be falling. But this guy here ain't moving at all. So it's like the yield curve's going to go back to flat. And even potentially, if these bonds really get going, we might actually go back into an inverted yield curve environment. Go figure. And ironically enough, it's people like Hugh Hendry who have actually, they have publicly come out and said that they are looking for substantially higher bond prices, which of course is a function of economic weakness. And, Hugh himself has made plenty, and I respect Hugh. I think he's a very smart individual. If you ever see the size of his head, I think he has twice as many brains as I have. But I think you could make the argument, reload zones, railroad tracks, A, B, C, D patterns, whatever. I think you could make the argument that Hugh's trade is working. And I would not be surprised to see bond prices up here, which this would be in a deflationary, and it would imply a recession and economic weakness. So I don't know how this is going to play out. I mean, nobody knows the future for certain. But one thing that did jump out at me through all of that was the way that the bonds actually were very, very happy through that entire speech, which I think is going to, like I said there a second ago, is going to translate into the yield curve flattening, and these rates actually falling. And do we have to go back into a inverted yield curve? I don't know. Only time will tell, I suppose, as they say. I suppose crypto, we'll finish off with a comment there and then maybe send you on your way. I think on balance, the Bitcoin story trapped between a moving average sandwich right now, which, if you've listened to any of my broadcasts of the past little while, I've been talking about this range bound market state for quite a while. I do think that we're going through a pretty tough sort of celestial window here. These eclipse seasons, they're usually kind of challenging for us humans. I don't think it's a surprise that we have the FOMC meeting right in between these eclipse window events. And we also have that options expiry also into that event. And I did find it interesting along the same vein as the S&P 500. If we look at the Bitcoin ETF, because of course this has now been officially securitized. So welcome to Wall Street, basically dominating this story now. Where's my chart that I can show you? Is it this one? I thought I had it on here. Oh, no, these are the futures. Let's head on over. Where is that IBIT chart? You're around here somewhere. Interesting. I thought I had it on here. We were talking Tesla in the daily brief here today, but maybe it was a little bit before this. Yeah, here's our Bitcoin ETF. So along the same lines, and this is had me scratching my head a little bit here recently. You can see on this Bitcoin ETF, these are the options that expire Friday. 34,000 contracts there, 34,800 open interest. These are the puts. Institutions write the puts. I think that there is a lot of incentive to try and get this market to go out just above that 54 level so that these puts expire worthless. That's my feeling right now. But 54 is an awful long way away here. So I don't know whether we can pull this off. If we look at this on the weekly chart, thinking about the Bitcoin chart that I showed you a second ago, 13 EMA sitting there 51.5. So we've got a huge hurdle to get through here. I think this is just too big of a hurdle to overcome here over the next couple days. I do think that these options are going to, where the hell did it go? Right? TradingView decided I didn't need that information anymore. That's kind of bizarre. What the hell happened there? All right, I did something wrong. Anyway, I get the impression that these options are going to expire in the money, which means that Wall Street is going to be long a bucket load of this ETF. Keep in mind, that's 35,000 contracts times 100. So that's like 3.5 million shares of this thing. When Wall Street, I don't think Wall Street really wants to be overly long anything in particular, but they're going to be forced to auto exercise on these things. So, under normal circumstances, especially with the S&P 500, I would say it's a pretty good chance. But Bitcoin is going to have one hell of a rally here over the next couple of days to get back above this line here. And frankly speaking, I don't think they can do it. So we'll see how that goes. And unfortunately, what that does mean to me is that probably, 13 EMAs act as resistance. And once we come back from that options expiry date, Wall Street is going to be long a bucket load of this stuff. 21st is coming up here, the end of this week. There's Monday, the 24th. So the options expiry is right in here. As I said, I don't think they can get this thing back above 54 now. So as a result, I hate to say it, and of course you guys don't want to hear this, but I do think that we're going to run into a big selling wall here. Usually, and if we take, good old chaos theory, fog and bombs, all that kind of stuff, usually markets like to move to 1.618 Shout out to Julian, TRI site principal, for adding this level to our chaos theory thinking. Then they actually like to, and I use this to trade futures contracts on a daily basis. Very, very powerful concept. But my experience of watching this is usually markets will like to play ping pong. So what a surprise, 13 EMA is there, and that is the original market structure, and we'd call this like a Wyckoff check of the original breakdown level. And then if we lose that 1.618, well, 2.618s are usually the technical objective next. And then, frankly speaking, we talked about this on the site quite a bit. I think you can actually make an argument the last buy signal on Bitcoin was right there, down, up, down, breakout. And this was basically the orgy of Donald Trump being elected, and to a certain degree, the public sort of casting off the communist, socialist bent direction of our society. The only problem is that this is too far, too fast. This is supposed to grow. I mean, hell, you can see where the trend line is. This usually should grow at a 45-degree angle. So actually not a big surprise that we actually came back to that level there. But for me to actually turn bullish here, I'm going to have to see some sort of W. There's going to have to be, like I said, a test of 13 EMA, a rolling over, a test of these lows. Is this low really for real, or is this just all fluff? That's a big tail. Brian, wicks and tails like to be eaten. And as well, too, if this candle, if this gap that you see on the Bitcoin Trust, this gap is technically filled in, then it actually needs a body, an actual candle body to come in and fill this hole in. This tail, that's just not enough. That's not enough to consider that gap actually filled. And then I suppose you could make an argument there's a gap right here that you could be filled, because that's where the close was and the next open was there. So there's an unfinished business there. And there's also a gap here at the original breakout point. So I could make the argument that there's a lot of unfinished business in this range here. So my general hunch, for whatever it's worth, is we probably have to come back down to this 2.618. Also, to A, B, C, D, bearish bots, all that kind of talk. Anybody who knows me knows I like the idea of being short from the 25 level. You move your stop to scratch at 50% tag. Did this come up and stop that trade out at scratch? It might have. Could we have a new top come in here and set up another trade off of this 25 level over the next few days through that options expiry? Yeah, I wouldn't surprise me. However this plays out, A, B, C, D, you can see the ultimate resolution, PRZ, is down in this 37 area. And then, of course, if the selling really gets out of control, 1.272s, and then 1.618 actually becomes like a no-brainer trade level. You can see this on the Bitcoin chart. It should look basically the same. So, you can pull up your Bitcoin chart and see. I guess we'll just finish off this broadcast with, are there other proxies in the space that are also exhibiting this sort of dead cat bouncy kind of behavior, but not necessarily in a new uptrend? Of course, if I'm going to make a statement like that, odds are probably the answer is yes. Ironically enough, with regard to Bitcoin, my cycle analysis actually suggests that will bottom around my birthday, which is like the middle of May. So anyway, take it for whatever it's worth. Ethereum, interesting chart pattern here. I still think that Ethereum is very much in a bear market. Market structure failure confirmed the bear here. Cascading lower highs and lower lows. Of course, and this is why it's so dangerous to listen to Donald Trump or any of his family members and take investment advice from them, because odds are they're probably actually trading against you. And they have absolutely no morals whatsoever. And don't kid yourself. There's no point in even having this debate. I've known Donald Trump for like, 20, 30 years. I'm in my 50s, by the way. And he's never had any morals, no scruples, no morals, no ethics. That's just not part of his behavior. So if he or his family, and I would imagine his kids are basically along the same lines, if they see an opportunity to take money from you, they will take your money, no doubt about it. Trump and offspring of Trump coming out and recommending Ethereum as a purchase here, horrible investment advice. Oh my God, what the hell are these people doing? So I don't actually think Ethereum can actually get back into a bull, ironically enough, until all of these people that were suckered into buying up at $3,000. Thank you, Eric Trump. I don't think that this thing can turn back into a bull until those people are released. I do find it fascinating that we have this wick up here, right? You could even argue, you often hear me say, wicks and tails need to be eaten or like to be eaten. And, these are a whole bunch of trap bulls in here that desperately need release. And I might argue that in the near term, the price got knocked down by almost 50% here. I think you could make the argument that we could enjoy a nice little dead cat bounce rally in this space because we've just been knocked down so hard. And all we'll do is we'll just rally back to trendline resistance, not really a new bull market. And at TRI, we have a basic rule that we can't really call a bull until we actually see market structure on the other side of this trend line. So that means that this whole area is just all open air. And I think whatever rally you're going to see in Bitcoin, in crypto, in the stock market, I think it has to do with sort of relieving this sort of egregiously oversold condition. It's interesting how Ethereum options were being bantered around, but I don't think that they actually have approved the options yet, which in a weird sort of way actually allows Ethereum to still be insanely volatile. Half of the reason why I think the volatility has come out of Bitcoin is because of it being securitized by Mr. Fink. And it actually has to move in a very orderly fashion. Remember that massive put wall that I made reference to there earlier. I'm not quite sure how that's going to be resolved, but I can tell you if Wall Street is forced to buy a whole bucket load of Bitcoin or Bitcoin ETFs up top here, there's going to be selling pressure here going forward. Anyway, so with all that said, I actually don't mind. I think there is a room for a bit of rally here through this eclipse window. And I might be curious, this is an interesting sort of side to all this. As I said, here's today's Fed. Here is the options expiry where I think they're going to try and rally the whole market into, try and get as many of those puts to expire worthless as possible. Once we're through this window, though, and here is the other side of this eclipse window, once we're through this window, I'm very concerned that we have to take another leg back down. So that's how I'm sort of talking to my audience right now, is enjoy this little rally window. I think there are some, this market's got some legs. I think we're in sort of like, and the way that I describe it to sight people is if you think about a hurricane, it's an absolute mess over here and over here. But ironically enough, when you're right in the eye of the hurricane, things are actually relatively calm. The wind is calm, there's blue skies, the whole thing. And I think that's what this eclipse window is. It's sort of like the eye of the storm. And once we move outside of the eye of the storm, then everything that we saw over here resumes itself. Anyway, that's the advising that I'm giving people. And I actually think through this window, you might actually see things like the stock market, like right now at TRI. And I started this conversation off with this. The market is actually extremely oversold. And it's due for a bit of a bounce. And ironically enough, I actually think the bounce has more to do with the options expiry than any sort of driver by the Fed. And in a weird sort of way, I think the Fed is actually kind of handcuffed right now. Mr. Trump's obviously got the inertia. And as I said there earlier, I think actually the Fed's biggest concern here going forward is going to be what happens when Mr. Powell leaves and his tenure is over? And what does the Fed mandate actually look like after that? So anyway, that's my 2 cents on the whole thing. So I think I'll probably leave the rant at that for today. Actually, this is probably not the screen I want to leave off on. Showed you the breadth, and I think to a certain degree there is room for this market to move up. I'll be very curious to see whether they can engineer some absolutely insane rally on Bitcoin to get this thing back above that 54 strike. But you never know. You might find that Donnie comes out overnight and announces that the Strategic Bitcoin Fund just went and market bought $100 million worth of Bitcoin, and all of you go absolutely crazy. I don't think that this is a good short location. Remember, you had Mr. Whale there the other day sort of saying, I'm short Bitcoins. And I was like, ooh, that was like here. I was like, oh, that's a bit dangerous. My general thinking here is over the next 24, 48 hours, I'm looking for this market to move up, actually probably even through the weekend. And then come Monday, Tuesday, let's see what this whole environment looks like going forward. So if anything, that's not bad in the short term. I think the market's got a little bit of wind behind its back. Okay, I think I'm going to leave the rant at that. Hope you got some value out of all that. Always fun to make fun of the Fed people. And of course, if you have any questions, feel free to pop in. I'll be on the TRI broadcast where you can ask me questions directly if you want on Friday. Tomorrow, you should get Julian's perspective on the market. It's always good to have different perspectives. Okay, I think I'll leave it at that. Thank you very much for your assistance today, Chris. Hope you got some good value out of that. PMA for the win, slow and steady wins a race. You know how all that goes. And of course, remember what your number one job is. Try not to take too much risk. And always remember that your number one job is just to make damn sure you can come back and play the game again tomorrow. All right, all the best, and bye for now.